Good morning, everyone. Good afternoon, good evening, depending where you are. Today is quite an interesting day in the markets. You know, if we have a look at what's coming up on Forex Factory, a lot of news announcements on the way. So any price action that you see unfolding has to be taken into account, bearing that in mind. I just want to quickly show you there's few markets that I'm not actively looking at, looking for setups today. First one, Brent crude oil. Just a recap, just a quick recap. So I'm always starting by looking at the daily time frame of the 7 charts that I'm trading, 7 markets that I'm trading: euro versus dollar, gold, US 500, FTSE 100, crude oil, Hong Kong, Hang Seng 50, and Nikkei 225. So I always start off with the daily time frame, and when I see a tradable setup, then I go down to the 5-minute and I look for execution. So the trigger, the thing that moves a chart from just being on the watch list to actually execution, is seeing a setup on the daily time frame. So today, so let me show you the ones that I am not looking at first. Crude oil, but kind of spoke about this before. Broken a major trend line. I mean, you can see just how strong the market was after breaking out above the high of last year. But the reason I'm not trading this is now on the daily, we're into a trading range. It's a major trend reversal alert. One of our patterns that we trade, high possibility of high returns, is a major trend reversal. So if this market was to reverse, certain things happen in the trading range, and if we can catch the bear breakout, there's huge possibility for high returns. So I'm waiting for that major trend line, major trend reversal to set up on the daily time frame. What are the key ingredients of that? First, we have the break of the trend line. Okay, that's what we had. When I see the trend attempt to resume and see if this high is tested, and if this high is tested and the lower high is formed, it means the bears are strong. When the lower high is formed and there's a signal on the daily time frame, then jump to the 5-minute, look for early entries and execute off that. So bit of waiting on that. Another one, FTSE 100, interesting pattern. We broke above this double top, and the wedge has been created. And whenever you see a wedge 3 push pattern, that's the market trying to break above a particular level. And if that fails, you can get a lower high and a trend reversal. Okay, 60% chance if it sets up all that you get a trend reversal. But bear in mind, with any trend reversal, you always start off in a trading range. So you got to trade it like a trading range, selling off at the top. And if it bounces at the bottom, if reversal isn't set up, you buy off at the bottom. So that's something to keep watching and seeing if we get a lower high. If we do, then definitely want to go and trade on the 5-minute time frame. The US 500 still, after the break above this double top. So we had a break of a trend line. Break of a trend line, see the trend resume, go to the previous high, and though the doji there is broken above the previous high. So in terms of looking out for a major trend reversal, the classic ingredients were in until we got here. If the bears were strong at this stage, they would have given us a clear double top, a lower high, and then we'll be looking to see if we can take the trade down to the bottom of the trading range and possibly a breakout. But at this stage, we have broken above that. So the mindset has to change. I'm no longer now in a major trend reversal alert. I'm now going to see, okay, the bulls are strong. They want to want a measured move about this. So strong breakout, give me couple of strong successive bull candles, then I'll look for a pullback. If I see the pullback bouncing off the 10 EMA, then I go to the 5-minute time frame and look for execution there. Now, the other charts that I have that are showing 5-minute time frame here are charts that I'm looking for setups. today is problematic, of course, because of the news announcement. So let's look at Nikkei 225. Okay, it's quite cluttered because of the stuff that I have on the 5-minute time frame. But in any case, we had an inside candle. That doji was an inside candle. This big gap up that I've colored in yellow there. Now, most gaps tend to get closed, which means that gap will get closed at some stage. That would be bearish price action. We don't know when that will take place, but inside candle breakout mode, today's is looking also like going to be an inside candle, but there's still big news announcements coming. So the small trading range that we have so far may be just a reaction to the possibility of the news announcements that are coming. Okay, but let's have a look at it. It's on our watch list. It's definitely on our watch list. Okay, there is yesterday. Okay, inside of that. So it's a breakout mode. Inside candle, inside the breakout mode. So what am I looking for? I am looking for bearish price action. Okay, so my mindset presently is, in fact, here's an interesting thing. Once I see a setup on the daily time frame, and I have my 60% bias, 100%, right? 60% of the times that I'm looking for shorts, for example, on the Nikkei 225. I don't change that during the day, okay? Because I find if I start to do that, then it's easy to make mistakes, because if it starts to move in the direction I'd originally anticipated 60% of the times, then I'm caught in the wrong position. Do I get out? Do I stay? What do I do? So I prefer to hold on to my assessment based on what I'm seeing on the daily time frame and trade that during the day. Now, 60% of the times you get the moves, which means 40% of the times it may still go against me. So if I see my setups, 100 setups if I'm doing my chart analysis over 3-month period, over the 7 charts, 60% of the times it will go in my direction, which means if I execute correctly on the 5-minute time frame, I make money. 40% of the time it will go against me, which means even if I've taken trades, if I've managed them correctly, I should be able to get out break even, by taking profits at TP1 and managing your stop. Or if you get stopped out, you get stopped out at the full risk, which is still fine. That works well in the trader's equation. So Nikkei 225, we are looking for shorts. Now, if you're going to trade short, what we need to see is a break beneath this low of yesterday. Okay, a strong break beneath the low of yesterday. And once we see a strong break, a strong breakout, remember we've always said, a breakout is only strong and confirmed if there's a breakout candle. If there is follow through, then we want to look for the pullback to the 10 EMA. If we get that first pullback, we trade it. Or if you don't get it, we wait for pullbacks to the 20 EMA, which could be two-legged pullbacks. So that's what we're looking at. So I need to just switch off my mails here so they don't disturb us. Okay. Yeah. All right. So right now, we got to wait. Just wait for price to come to this level, see if we get a strong breakout and pullback and look to trade. So far, right from the open of the day is looking bearish. There's the open of the day. Price is down here, but we're not trading within here. We're waiting for the setup that we can trade. If you had been in the market on the Asian session, if you were up early, okay, there is a trading range that it formed. There's a breakout beneath it. There is follow through. Okay, so these couple of candles, very good for the bears, confirmed bear breakup. But where do you trade? You want to wait for a pullback to the 10 EMA. Now, we're waiting for a pullback and immediately we get a dodgy candle. So we've been given a trading range. That's not the pullback that we want to trade. We want the market to pull back several, 1 or 2 candles back to the 10 EMA, see a clear bounce off the 10 EMA, and then take the trade. So there would have been nothing to execute here. So you wouldn't have missed anything, if you've been in during the Asian session, you'd have been waiting, right, and not taking any trades. At least not the way we trade, because we're trying to take these trades that enable us to hold and have high returns, swing trading. We don't want to get in and out. We want to get in, hold the trade, and build a position as the day unfolds. So this is not surprising, again, because of news that we anticipate. Okay, another chart that is on our time frame, on our watch list. Okay, I'm gonna put up the daily again. It looks a bit messy because of everything that we've got lined up. Okay, so that was yesterday. Okay, low of yesterday, just slightly higher than the high of yesterday. So it's not an outside candle. If it's not an outside candle, I'm happy to look for shorts beneath that. If it had become an outside candle, then it's the trading range. And if it's a trading range, you just look to buy at the bottom and sell at the top. So I've got the Hang Seng in as a potential sell. If it goes in our direction, how far would it likely to go? There's a measured move. Okay, high of yesterday, low of yesterday, potential measured move. If you're trading the daily time frame, the way that we trade, you would have been triggered already into that trade. But if you did that, your stop would be up here. That's where we put the stop. We don't put it above here. We put the technical level there, and you'll be holding. Say, well, if I get a pullback, I'm going to hold to see if I get a measured move all the way down here. So that's the kind of direction where that's how you be trading on the daily time frame. It's a perfect setup in terms of our probabilities on the daily. So on the 5-minute, we go down and we look for opportunities to trade it. That's why it's on our 5-minute time frame. Okay, so if you were in the looking at it, Asian market, that's where we're looking to take our trade. If we get a setup earlier than this, we're going to take the trade. Okay, so as the market opened, the bulls trying to remember. Let me not say remember, because I haven't covered it in detail. I was speaking in Trading Buddies show with Jeff and Ash on Monday. And these levels that we put here, that's a 50% pullback that we put in for the high of last year, low of last year. So that's a key level that the market is trying to break out from. Okay, so bulls tried to break out, failed. Nice pattern here, inside pattern, breakout mode, but we're not trading that. That's fantastic. We see that. Now we want to see the breakout of that. We want to see a pullback and trade. You didn't get it before the breakthrough yesterday. Slow, fantastic, but we still had a strong breakout beneath the low of yesterday. We had a pullback, didn't quite get to the EMA, but that's a trade that would have been worthwhile to take. If you take that trade, your stop has to be right here. Okay, because that's a breakout, pullback, first entry. Take it there, and where would you be hoping to go with that? Two ways to measure it. Measured move of the breakout. So that's the end of the breakout. There's the beginning of the breakout. You want to take it to there. So the market could have gone leg one, pullback, leg two, and gotten all the way down to here quite easily. Alternatively, where else do you want to look to take profits? Look to take profits at, there's the first leg of the move, which ended there. And there is the resumption of the second leg. So our entry would have been here if you had been in this market in the Asian session. And you put your stop, that's the first leg, but you put your stop above here, a little bit more aggressive, you could put it there. Okay, and you want to hold it until you get here. That's what you do. So all of these pullbacks, there is no clear reversal. You wouldn't touch your trade. Just leave it. Leave it as it is. If you take that's a strategy trade. So that we take as it comes. Now we've had a pullback, which has gone back above the high of yesterday. It's so that's a 50% as well. So pretty significant, right? The low of yesterday is also the 50% of this breakout, but the market has gone above that. Still, our trade our stop is where it should be, and we haven't been stopped out. Now we got to wait to see if you've taken that trade. You can't build into a position. If you haven't taken that trade and you come into the market in the London US session, you've seen all of that. You've seen the analysis from yesterday. We have to wait to see if we get another opportunity to get into the market. So this double top, another double top, absolutely key and perfect for us. Okay, at this point, before you saw all of that, you said, okay, fantastic. What I want to see now is bear resumption. Give me a couple of strong candles like we did here. And if you give me a couple of strong candles, I get a pullback to test that, I get a lower high, I take the trade. We didn't get that, but instead we've gone sideways. Okay. Now we have a double top that has been created. So first attempt to get above that level, failed, second attempt above that level. But what we're still looking for, we're not getting. Okay. What we need to get is strong price action, strong bear price action. 1, 2, 3 candles beneath that, pull back, then we can look to take it short. But if you've taken a trade there, you're not doing that, not adding to a position. You got to wait for the price to go beyond your level, set up nicely. Your stop can then be pulled. Once the market starts to breaks beneath that and pulls back, your stop can go from here to there. At some point, if that carries on, lower highs, you can tighten your stop accordingly, then you can build a position. But that's still on our watch list. We're still waiting for the opportunity to jump into that trade. Gold, let's have a look at gold. Again, gold is on the watch list as a sell, and it's already triggered that sale. But what we're going to do, let's just have a quick look at, oh, what a mess. But anyway, I'm sure you can discern. Okay, because of everything we've put on the 5 minutes. Yesterday, we had an inside candle, inside candle, breakout mode, the outside candle, inside, another inside candle. So breakout mode, that's why I put it on my execution, looking for shorts. So we're looking for shorts on gold. Now, let's just go into the 5 minutes, get a bit more clarity because of everything that we've kind of marked on that. So hopefully some of this stuff in the way that we look at the charts is gradually and slowly becoming easier to work with. The more you get exposed to it, the easier it becomes. So there is the high of yesterday, low of yesterday, potential measured move. Ignore that chime. Someone will pick it up. So that's a potential measured move in terms of the extension of the range of yesterday. So the market has broken beneath that. So let's see what entries you would have had, if any, during the Asian session. So presently, we are still bearish. We are waiting to see if we get an opportunity to go short on gold. So there's a few currencies that we're looking at. Could be a long day for me, actually, because we've got news coming up. We kind of, if not in trades, we step out, let the news wash through, give it 2, 3 candles for the market to settle, see if there's opportunities, jump in if there isn't, wait if there isn't. Then we've got to wait and trade our way through to the end of the US session, the overlap with the, end of the UK session, overlap with the US session. But then we've got this FOMC report that's coming up. That's always turbulent. Now, okay. I just want to show have a good look at the news, but there's multiple news that are coming up. You always, if you're trading off the lower time frame, 5-minute, 15-minute time frame, possibly even hourly, when you have multiple 4 or 5 different red news, just stay out of the market. No matter how good your price action read is, 100% correct 60% of the time, there is so many forces that come into the market that you just want the news to be announced, give it a candle or 2 on 5-minute time frame. By the third candle or 50 minutes, start to look at the patterns and see what's happening. So I'm going to stay in and see, because sometimes you don't have clarity after FOMC. It's just it just doesn't settle enough for you to have enough clarity to take trade. But sometimes after a strong breakout, it just becomes absolutely clear. You put your 50% pullback, and the market comes back to that. It tests that, gives you an opportunity to jump into the trade, small risk, and just trade it and see what comes out of that. So, as much as the market may go sideways, it also can provide a lot of opportunity. So, Asian session, gold. As the market opened, sideways price action, nothing for us to trade there. Okay, and it's important because when you come in, your eyes may say, oh, hang on a second, double top, I could trade that. But you trade in that based on what? Where have you seen successive bear candles that shows you that the bears are in control? Right now, all you see, this is trading range price action, bull bear, etc. You got to wait to see the breakout. So when you see that breakout, beautiful one would have been a couple of small candles, not small, still huge, but half the size, and a pullback. But we didn't get that. We had this surprise candle, almost double the opening range that we had so far. But when you see that, well, it's fantastic. You got to wait for your pullback and see if you get a pullback to the 10 EMA. That's what we're looking for first. After a breakout, we want to see the pullback to the 10 EMA. Then at the 10 EMA, which we use as an indicator of strength of the breakout, we want to see the bounce then we want to trade it. So when the market got to the 10 EMA, if we did a 2-bar reversal here, that's what you should have been trading. Okay, broke above that, came back and didn't give you the entry off the 10 EMA. So there is nothing for us to take and trade at that particular stage. Okay, lower high. Okay, now we have a lower high. Wait to see if we get a decent entry, another pullback to the 10 EMA. We get that pullback, 2-bar reversal, slightly outside out candle. So not perfect, but if you're going to take that, which you can do, put your entry here, but your stop has to be all the way up here. Okay, the way we trade, we don't just put a stop above here because we're not trading the actual candle, we're trading the pattern. Okay, I know some of my colleagues trade the actual bar, the actual candle, they put a stop there, wait to see. That's a different way of trading. We're trading the pattern and want to see if we can hold it and get the most out of it during the day. So you'd have put your stop above there and you've been triggered into the trade. Now, just quickly, how do you manage the trade? There's 2 ways to manage the trade. One of them is once you've taken the entry, okay, and you're happy with your pattern, leave the stop where it is until we get a breakout beneath a previous low, in this case, and we get a pullback and the market begins to resume again. When you get that, you can lower your stop to there and you wait for that to repeat again, break beneath a previous low, market pulls back. When the market starts to track down, like now we have a low, you can bring your stop down to here, okay, this high. In this case, that would have been break even. Okay, that's one way of trade management. Another way, which works also perfectly fine, is to use the take profit one and then tighten off the stops. And how that would work is you set your take profit one at a 1-to-1 level. So it means you will have to have 2 trades placed as orders. So let's say the loss that you're risking is 1, for argument's sake. You'd have 2 orders in the market, one at 0.5 and 0.5. And what you then do is, first order, okay, our stop is 32 pips, 33 pips. You take out the full profit at 1-to-1. So your full risk of 1% equates to 1 lot. Then you break that up into 2. You place 2 orders in the market, 0.5 and 0.5. The first 0.5, you want to take out the profit at TP1, which means you've banked 0.5%, safe in the bank. And the moment that is then triggered, that take profit is triggered, you then go back to your loss, your stop loss, and you tighten your loss. I would then tighten my loss to the height of this candle, or to a 50% pullback. Okay, so that's where the entry is. That's where the stop was. Okay, it's about the same. So in this case, so you could say, okay, I've taken TP1, I've banked 0.5%. On the remainder, I'm going to tighten my stop to 50%, because I don't want the market to come back from TP1 and go all the way to 50%. That's how I do it. I wouldn't tighten it to break even until we have the lower highs created. So you could have done that on that trade. Now, coming into the market now, so if you'd taken that particular trade, okay, until you've tightened your stop to that level, there's nowhere else for you to add into the trade at that moment. We then have micro double top, which is a lower high. So fantastic. Whenever you see, remember, you always want to see the pattern. There is a lower high with this micro double top. Okay, both these function as one top for me. Remember, I'm always looking for at least a 6-bar separation. Okay, I don't want to say, oh, there is a lower high. Okay, take a trade. Allow the market to give you more information. And 6 bars, 6 candles of the 5-minute time frame kind of confirms the top. So in this case, we pulled back, but that's all a double top. Then you'd be waiting for a lower high. Breakout, pullback, you could take that lower high there or there, but your stop has to be up here. Okay, because now you're holding to see if you get a test of the test of the low of the day so far. You're already, this is a key trade that we want to hold as far as we can and see whether, by the end of the day, that the remaining 0.5%, or if the market is broken to a low and you've tightened to break even, if that can give you a much higher return. So you're holding to get here, and because you are trading a trading range. You are now trading a trading range. So you can take profits here. If for any reason you didn't take that, and you're not comfortable to take it because it's the middle of the trading range, there will be other opportunities here to enter into the trade, but stop still there, but aiming for here because it's a trading range. Once that's done, we now have a trading range bottom, lower low double bottom. Okay, and we have this top at that point where whatever that's a lower high, and the market breaks above that, fails to break above the previous lower high. Okay, so here we now have double bottom, double top, trading range. So clearly you want to keep trading it as a trading range. 2 candles closing, good, but we have a doji, so wait. So now we are in waiting mode. What are we waiting for? We just want clarity to take a trade. We have a double top, fantastic. We're now just waiting for the signal pattern that says take a trade. Now, how do we identify that? We're gonna now start going into micro analysis of the price action. Market tried to go up there, failed, came back again, failed. So we may get a third push. If we get a third push here, that's a wedge pattern, 3 attempts to get to this high. If that fails, then we want to look at the succeeding price action, successive bear candles. Then we can look to trade a couple of bear candles, lower high, and we trade. As long as we trade in this part to go to the bottom. And our goal is going to be here. That's what our goal is going to be. So gold, we're still short, still bearish. We're just going to wait for the price action now to give us an opportunity to jump in. Okay. So I want to see a third push, at least. If we don't get a third push, what else could happen? I mean, this is still just 1 minute after 12, but let's assume this ends up as an inside candle, okay? Then another inside candle. What you'll be able to see, if it does that, is we now have a convergent triangle. We would have a convergent triangle. So either that, and any time you see any form of convergent triangle, it's a breakout mode. Okay, so if that ends like that and we get another inside candle, that is perfect, breakout mode. And if it's bear candle, then we're looking to go short, right? And we look for trades, but I'll stop up here. So let's just keep our eye on that and see. Okay. Then euro, let's have a look at euro. Ooh, look at that. Okay, let's just put up the dailies. I'm sure you can still see. Okay, you can see daily a little bit more. Just to follow the rationale of why euro is on the execution list in terms of today, and it's we're looking at it as a sell. So again, we had that bear candle for yesterday. So that's yesterday's high, yesterday's low, right here. Okay, we had a bull candle, slightly higher high, which is not a problem. But then when this huge bear candle formed, if you remember last week, we kind of spoke about this level of resistance, and we said you got to see that as a trading range, and any attempt to break above that will fail, because most breakouts fail, and an attempt to break above a trading range top is likely to fail. So when you saw that and you're the wedge top and test of that level, very strong level of resistance here. So whether you participated in that on the lower time frame or not, it doesn't matter. But now you can see that the bears are strong off this wedge pattern, 1, 2, 3, off this top of the trading range, sideways price action, off the test of this breakout point. So in the market, you can assume there's a lot of sellers in this area. Now, with that in mind, yesterday, as it set up, clearly says to us, okay, let's go this must go onto the execution watch list in terms of a sell. So we're looking to sell the euro. Okay, decent enough signal. And remember always, if you're trading the daily time frame, you'd put your entry beneath that, and your stop would be above that, and you'd be hoping for leg 1, pullback leg 2, to go and test the midpoint of 50% pullback of last year. So the 5-minute time frame, one that we're trading off. Let's give you sight first of how we're seeing things. High of yesterday, low of yesterday. If the bears break beneath this, there is a measured move. That's how far the bears want to take the market. And of course, you know, when you see that it should give you assurance that whatever time you come into the market, if the bears are strong and they close beneath this, there is a measured move. So you really can never miss out anything on the market, depending when you come in. Now, what is interesting, and we'll open up the charts right now. Low of yesterday, high of yesterday, 50% pullback. 50% pullback of any trading range is a significant level of resistance or support. In this case, because we're currently for the bearish position, that's level of resistance. If the bulls were strong, they want to break above that 50% pullback, demonstrate their strength, come back and pull back, or just continue up. But of course, you can see there we clearly reverse. So the bears are still strong. So our case for the bears is still a strong case. Okay, so I'm hoping I'm not going through all of this too fast. If there's any questions, just pop them in the chat box. So attempt by the bulls to break above the 50% pullback, immediate failure, 2-bar reversal, so the bears are strong. So that's very good for our bear case. Now, when we've seen that, and we had this double top forming here, attempt to break beneath that, failed. Again, bulls came back, attempt to break and failed. Every time you see a failed breakout above a double top, that is a form of a 3-push pattern. 3 push patterns are very significant for revealing to us the attempts by the market to do something. So here the market went up, sideways price action went up, failed double top, came up again a third time, failed to break out above that level. So we had a wedge pattern there. So at this point, before all of this had formed, you would have been looking for coming off the wedge top, off the third push, strong bear candles, okay, successive bear candles. If we had been given that, and then a pullback in a lower high, that would have been a trade to take. But we didn't get that. Again, the market attempted to resume. See, these measured moves are quite powerful. So slight trading range here, broke out above that. Bulls wanted to get to that. They got to that, but immediately at the measured move, the bears came back into the market and reversed it. So positive for the bulls, strong bear price action. Now coming off that, what we want to see would have been strong bear candles and a pullback. These tails are problematic because they're still indicative of continued price trading range price action. Okay, so what you gotta wait for when you see that we close to the bottom of the trading range, there's buying into the close. You gotta wait to see if the market comes up again here and gives us a double top, low high double top, and see if we get a decent enough setup. So there's gonna be a lot of sideways price action, but because we're not ignorant of the day that we're in with the big news announcements coming, so you gotta just trade with caution. There is news announcement, I think at 2:15, and we need to be out of the market if you're not already in trades by about an hour before that. Okay, so just a quick look again to see if anything has formed. Nothing yet is formed. Hang Seng, Hong Kong 50, still in kind of waiting mode. Well, we want to see successive bear candles. Successive bear candles, we're still waiting for that. Oil not on our watch list. We mentioned that because we don't have the proper setup. FTSE US 100 gold, all in weight mode. And euro versus dollar. Okay, so what I want to do while we wait is just what I want to do while we wait. I want to show you something in terms of how to trade when this opportunity comes up. It's on the euro. Okay, we will come back and have a look. Okay, so just ignore the just ignore, if you will, my horizontal levels of support, because that's what we have for today. In fact, I'll tell you what, I can quickly take them off just for clarity. I can put them back on again. Now, this particular day is quite interesting. Just to talk about when trading range price action kicks in. I do that quite a bit. Okay. And there's nothing wrong with doing that. You can see this, let's extend a bit more. This trading range formed in the early part of the Asian session. And you can see how the market tried to break out beneath that a couple of times, broke out, came back, tested, but eventually there was a successful breakthrough that gave us quite a dramatic move for the day. Now, that dramatic move took place late part of the US session, London session, into the US session. 2 points. First point is that, and I've said repeatedly, it doesn't matter what time you come into the market, there's always opportunities to trade, as long as you know how to look out for your price action and also how to wait for the opportunities to come your way. Now, easiest to see is this trades, but there's many other opportunities that appeared here. Okay. So I'm going to just keep that there so you can see. But when you come into the day session and you're starting off on the Asian session, and you're trying to decide where do I take a trade? You know, everything on the right hand side is going to unfold before you. But where do I actually start to take trades? You would have seen that outside candle. Okay, so you had the low here, you had the outside candle. That outside candle is a key determinant of what's going to happen. It's a trading range that's formed. So you want to be clearly looking for any breakout above that or any breakout beneath that outside candle. I mean, the open of the day is pretty close to that, but that's decisive as the day starts to unfold. We then have an attempt to break out beneath here, but it fails immediately. We have a follow-through, breakout, and again, a reversal into that trading range. As that forms, you now have a double bottom, but clearly now from that trading high, you have a lower high, you have another lower high forming, and you're now asking yourself, well, if the market is forming trading ranges, how do I trade? Well, I sell at the top, buy at the bottom, sell at the top. That's what you're beginning to look for. Okay, so you've seen that. That's the key levels that you're looking at, and you've seen that. First attempt to break out, failed. Second attempt to break out, again, market went back. Third attempt to break out, again, reversed. What is that? That's a 3-push pattern. Any form of a 3-push pattern is an indicator for you that the market has tried 3 times to break through this level of support. It might reverse. So when you see that, brilliant. We've always said, now wait to see what happens at the moving average. We get a breakout above the moving average. You haven't seen all of this, and now you're saying, okay, if I get another follow-through breakout, and a pullback to test the EMA, coming off this wedge bottom, I'm prepared to take the trade, put an order and stop here. But immediately you followed by a failed breakout. Okay, then you must just stop and step out. And we don't want to try and don't try and force the market to work. We just want to wait until things are clear before. So no opportunity for us to go long. And if there's no opportunity to go long, we're still in a trading range. Okay, so we wait to see what's forming before us. We're this high, we're that lower high at the extended. Okay, market comes back and turns. No surprise that it's turned there. There's the double top. So you didn't get the setup there, lower highs, double top. I want to find ways to go into the market, and because I'm looking at trading the trading range now. Off my double top, if I get a decent enough entry, I can trade it. Back in the trading range, pull back, reversal, there's an opportunity that you could have taken as a trade. Okay, if you've taken that trade, because we haven't broken beneath this low that formed that high, your stop has to be above here or above here. Okay, so there's a trade you would have taken. If you didn't take that trade for any reason, when you see another decent enough setup, there's a trade you could have taken. Okay, again, if you didn't take that trade, you should have by now, but if you haven't, all perfectly fine. Market is forming lower highs. Okay, so you could extend that if you still wanted, but avoid clutter. So if you didn't take that trade or that trade, when you see that failed break above that trade, because it's a failed attempt to break above that, take a trade, tail, bit of a problem, wait for the next candle, you could take that trade. Okay, so you can take all of these trades. Now, because you've had successive lower highs, you can put your stop above here. Okay, so trades that you could have taken on this particular day, the key point is waiting. When you see price action going sideways, don't be sucked in or don't be kept out of the market by all these tails and dodges and sideways price action. Just try and look for the extremes. Where is the market turning? Where is the market failing to break out? In any case, if you've taken that trade, and you could do that for any of these trades. Okay, you've taken that trade, potential measured move is down here. Okay, you could have done that for any of those trades. So, but again, you don't ignore that bottom. Now we're holding out for the measured move. Perfect thing to do. Okay, if the market turns here, well, you need to manage and get out of your trade. So when you get to the measured move, now, here is a little bit of micro analysis that makes price action trading buy by bar quite exciting. So there is where you want to take your profit. Okay, you're trading the trading range. There is where you want to take your profit. Now, if you don't take your profit here and you think, okay, maybe I might get acceleration, you always have to be actively looking at the market. Breakout beneath that low, fantastic. Follow through, yes. Whenever we see a breakout and a follow through, the thing that goes through our mind is, hang on, I want to see if I get a pullback to the 10 EMA. Reason being, if it's a strong breakout, it should come back to the 10 EMA and bounce off that. That's the trend line that we use for strengthening a breakout. You get an immediate pause and you say, okay, maybe I'll get a pullback. You don't get a pullback. You now get follow through immediately from there. That should raise alarm bells for you if you're in a trade. Okay, there should have been an attempt to test that level, which allows me opportunity to get in on the bounce off. If it's not there, something else is happening. I need to have clarity. If I'm managing my trade, if I'm not taking all my profits off here, I need to be alert so that I don't lose my profits. We get another pause. Okay, attempt to break out, another pause. Now you have first attempt, pull back, second attempt, pull back. Then right beneath your measured move, you have another attempt to break beneath that, but a failure. That's a micro wedge, which is an indicator of a reversal pattern. Micro wedge simply because it's happening between a few candles. There's no difference in terms of the forces at play beneath this pattern forming here and this pattern forming here. So if you were a bull and you saw that pattern and say, okay, fantastic, wedge bottom off a hidden level of support. Let me see what happens to at the EMA and see if I can jump into a trade. Okay. So if you see that and you're holding on to shorts, you don't want to keep holding on to your shorts. You want to take your profits. If you want to hold on to shorts, take some profits off and make sure that by this time, this breakout, you can move your entries to break even. But a perfect place for you to take profits at. Micro wedge is the same as this kind of wedge pattern. Sometimes you have here. Here's another one. Just jump to that. Okay, market goes down, comes back again, goes up, comes back. Very large pattern compared to here, but it's still the very same forces that are at play. At the third attempt, if the market fails to break beneath a level, the third attempt, it reverses. And then you want to find ways to get into the trade. Market attempts, it reverses. Okay, so no surprise there. All of these ought to be no surprise. So if you had been in a trade, take out the trade. If you had not been in the trade and you've seen all of this price action, you've seen the break beneath, etc., you can look to go long in here. Where would we go long? This looks beautiful. But with the way that we trade, because we're not trading breakouts, we're trading pullbacks from breakouts, there would not have been an easy opportunity to jump in because you didn't get the pullback. Would have wanted a pullback to test here one candle, then you can put an entry above that and put a stop here and go to the top of the trading range. Okay, pretty sure there are other ways to trade it quite easily, but we're going to stick to our stories and trade the way that we trade. So you would have had decent enough entry, made decent enough profit. Seen this and not had the pullback, bit of a disappointment, but that's how the market works. There's no way for us to jump in here, no higher low, leave it like that. We still have that trading range that we spoke about. Can still see how it's controlling the market, the high of the day so far. Despite this strength, market gets to that high and turns back immediately. So in your mind, you're saying, okay, this is just a double top continuation of what I've seen. Now, what I have is a larger trading range. That's what I have. Now I have this high and that low. I now have a larger trading range. Off here, if I get a lower high, happy to take the trade to come down here. There is a lower high. You could have taken double top, lower high, and you're trying to get to the bottom here. You've seen leg one, pull back leg two, leg three. When you see the wedge pattern that's forming instead of successive bear candles, then you need to be alert for a potential reversal. Okay, your stop would have been there. So potential reversal, if you hadn't managed to trade by seeing the wedge and coming out of the trade or tightening your profits, when you get a lower high, you will probably have been stopped out there, which is fine, Okay, I clicked the wrong tab. Okay, this is what I want to show. All right, so you now have this large trading range that is formed. You see in the wedge, and immediately you see that bull candle. You kind of say to yourself, okay, if the bulls are strong, we are going to get a measured move. Okay, if the bulls are strong to break above this trading range and this high that has been controlling the market, we are going to get a trading range. If we get a trading range, a measured move, then I want to take profits at the measured move. Okay, and that's one of the points of this. So I haven't seen all of that, and you see that, I say, okay, nothing for me to do here is a breakout, strong reversal of all of that, follow through candle. This is actually the breakout candle. This has broken above these previous highs, but what candle is broken above the most significant high of the day is this one. It's a doji candle. There's no follow through, so nothing for us to jump in at the moment. Let's wait and see what forms and if we have opportunities for us to get into the market. Now, we then have a breakout, pullback, the market comes back, lower high, you could have that lower high, which tests that, or you could see that as an anomaly. Okay, so after that breakout, now we have a new higher low. Breakout, pullback, nothing for us to trade there. Market has carried on to now is pullback. Now we have a higher low. This low is higher than that low. It's also higher than that, which is good for the bulls. But we've seen a pattern. We don't trade the pattern. We now wait for the actual entry. Okay, if out of here, so all of this beautiful stuff is not formed. Okay, all of that is not formed. So we kind of here and we're analyzing this and we're saying, okay, from here, if I get a decent enough entry, then I'm going to look to go to take the trade. But from a higher low, I've got to see strength. I've got to see the bulls exhibiting strength. Bear candle, bull candle, doji, yes, market going up, but no successive bull candles for me to trade. Still very significant. I need to wait. 3 successive bear candles, market turns, gives me another higher low. Good. So I'm here at that moment. I'm saying fantastic. I just want the bulls to give me strong bull candles to confirm that you're in control. I get a doji, I get another bull candle, and the market turns. Now I'm getting that low high, that low high, that lower high. Okay. Again, market turns, fails, and what we are seeing, and that's what I wanted to get to, converging triangle. Converging triangle is breakout mode. Okay, breakout mode, when you see a converging triangle as breakout mode, it means the market is going to break out in the direction typically of the defining candle towards the apex of it. Okay, so now we have a breakout. This point, bull candle, breaking out above that, follow through candle, pull back. We just want to get into the trade. But if we're going to get into the trade, the key level that is going to control us is where we put our stop. So now we can actively start to find, because of the breakout mode, most breakouts fail. There's a breakout pullback. Okay, I1, we can't take that trade, but off EMA, you could take a trade there. Okay, stop has to be down here. Then we got to wait to see if we get another opportunity. If you haven't taken that, if you've taken that, you are hoping for acceleration up, pull back, and then you can carry on with the trades. If you haven't taken that trade, now you got to wait to get another opportunity. And the other opportunity comes in when we have, still that's the key level. Now off this double bottom, off this high low, we have a double bottom. And once we have that double bottom, again, we can look to take any trades that's set up for us. We can take a trade in here, then you're going to wait for a pullback, and you don't get much until you start to get setting up there. So I'm kind of running out of time, but I wanted to illustrate a couple of things, just the defining things when you enter into a trade. You got to clearly see what's forming the highs and the lows, clearly identify the trading range. Look for your 3 push patterns, look for the breakouts, look for the higher lows, breakout modes. It looks complex when you just look at the chart, but when you go by bar and look for the patterns, you can find opportunities to trade. Guys, thank you very much. Might have been a little bit busy, but let's keep watching the markets and let's see how it goes. Guys in the office, thank you very much. Watch out for those news coming up and wait for the patterns to form in front of you. Thank you, guys. See you next week.